Hi, and welcome to our end of May update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build wealth. And 50 years ago, at the end of May, John F. Kennedy made his famous speech stating, "The goal before this decade is out of landing a man on the moon and returning him safely to the earth." Now, those of you who have read my book or have been listening to my videos are aware that I've been hinting that for us physicians, saving and investing isn't enough. Saving and investing is like shooting a rocket to the moon, or whatever the financial goal is. However, look at the speech. The key phrase is returning safely to Earth. That's because if you ever retire, you cannot rely on income from your job or save you if your investments go bad. In fact, one reason why even thinking of retirement is such a headache to us is because there's so many unknowns. What if I die early? How can I make sure my loved ones are well off, at least financially? What if I outlive my savings? Ooh, that's a good one. Factor in those other unknowns like taxes, unforeseen life circumstances, kids moving out, kids moving back in, divorce, wars, recessions, medical bills so large that they bankrupt us, taxes jumping around unpredictably, inflation becoming bigger than we think. I'm getting a headache just thinking about all this, and we're still just scratching the surface. So, yes, the financial advisory industry, there is a specialty emerging called retirement income planning. Kind of like how geriatrics and anti-aging medicine are still in their infant stages now in the medical field. But that's reality. We're living a lot longer than we used to. 30 years ago, when life expectancy was only a few years after retirement, planning wasn't that important. Nowadays, with life expectancies in their 70s and 80s, by the time you and I reach our 80s, life expectancy will no doubt be even higher. Science marches on, and as we solve the problems of premature death, we've been creating new ones, which is actually a good thing. As we grow, either individually or as a society, as we solve problems, we trade in problems for higher quality problems. And sure, there are the Warren Buffetts and the Charles Mungers of the world who work 12-hour days way into their 80s and 90s and love every minute of it. And if you're one of those masters of your craft and crave working and are completely fulfilled working despite increasing stress and regulations, I salute you. You do not have much of a retirement problem. But for most of us, the retirement problem comes with what to do if we no longer have an income from our jobs. And yes, there are ways to ensure that our loved ones are taken care of financially if we were to die prematurely, and yet at the same time ensure we have adequate income if we happen to live unusually long. Once we take care of these two retirement problems, then we're free to grow our nest egg as large as we want. And to take care of these two retirement problems, we must start planning during our accumulation years. By now, you're probably guessing that my complete system consists of a three-pronged strategy, of which market investing is only one leg. One reason I was able to consider semi-retirement at the age of 45 wasn't just because I was investing my own particular way for 19 years. In 2004, my son was born. I did the usual thing of going to an estate planning lawyer and figuring out how to financially protect my son and my wife, who was now no longer working. I of course did all the usual geeky stuff, read the dummies books, the pundits like Susie Orman, gathering all the information, drilling down the numbers, trying to figure out what worked best for me. I read books like Castiglione's LEAP system, Lifetime Economic Acceleration Process, which gave contradictory advice and solutions to what mainstream media was offering. It was great. Both sides provided arguments for their strategies and against competing strategies, and it was up to me to drill down the numbers and fit the pieces of the jigsaw puzzle together. And as a result, 8 years later, I'm semi-retired. And I would love to share my retirement solution with you. There are two roadblocks. The system I use is proprietary. No, I didn't develop it, but I do use a modified version, but it's not modified enough that I can just put it out there without permission. And yes, I use a modified version, that's because everyone's financial situation, goals, etc., who you want to protect, all vary from person to person and family to family. There are enough moving parts to this plan that it would be a good idea to consult one-on-one. So that's why I've been struggling for a while to put this information out. I cannot put the information out, but I feel I must somehow get the information out. After all, this is a critical step in how I was able to contemplate even semi-retirement. I always hated it when other financial advisors would do this to me, tease me with all these problems that they can solve and say, talk to me later about a solution. But now that I look at it from the other side, I can see why financial advisors are kind of locked into what they do. So what I'm going to do is at least see if I can get permission to discuss certain pieces of information with you in the future videos without violating any proprietary agreement. It's the best I can do, guys. The financial industry is fragmented and overregulated, even worse than the medical industry. And even though all this legislation is meant to protect us investors, it's also a double-edged sword. So, on to this month's data. The first system is the 20-month moving average system. Now, just to clarify, even though I thought I've been making this clear, moving average, it's the average closing prices of the fund or whatever it is that you're looking at over the last 20 months. You don't have to do it every day, just the closing price of each month for 20 months, divide by 20 months, that's the average. And if the markets are going up, the average tends to be below the underlying. So the first system is this 20-month moving average system, and if we do the calculations, the S&P 500 index fund, ticker VFINX, for the Vanguard fund I used to calculate, last closed at 194.97, and the 20-month moving average is 178.96. So again, 194.97 over 178.96, we're 8.9% above the 20-month moving average. So we have this 8.9% cushion if the markets were to tank next month before we have to yell uncle and get off stocks. Again, here's a rule that we use for the 20-month moving average. Just 2 rules. I've gone over it before, just read it. Pause if you have to. Next system. Next system is a completely different system. It's the MRI, the monthly rotation investment system. It's still my workhorse. And this month, the emerging markets start to drift down. Thus, the winner of this month, the S&P 500 index, this blue line. You can see graphically how these 3 funds performed this past month on this graph. So, with our current model, if you remember last month, we were about 50% S&P 500 index, 25% emerging markets, and 25% the inverse fund. And if you remember, the S&P 500 index and the inverse fund cancels out, so if you were 50% cash instead, that's perfectly legitimate. This month, since the VEIEX was a loser and the VFINX was the winner, you sell VEIEX and buy a unit of VFINX, and a unit is roughly a quarter of your investment account. So this crosses out in terms of VFINX. We are now 3/4 VFINX, 1/4 inverse fund. And since one RYURX, the inverse fund, cancels out one VFINX, we're roughly equivalent to 1/2 cash, 1/2 VFINX. So here again, the MRI rules. I'll leave this up for you to read. It's a video, you can always pause this. It's a very simple rule, just rank, sell the bottom 25%, buy the top fund. Now, next system, completely different system, again, dollar cost averaging. You can use this with other systems, but remember, stick with it. Just in case some of you still haven't contributed to your IRA or 401k or HSA or any of these other funds that you periodically deposit into, now's the chance. Don't forget. And then, of course, the trailing stop loss method for buying an individual stock on a stock tip or stock rumor. Again, if you're buying stock, monitor at least weekly and keep ratcheting up their stop loss order if your brokerage doesn't already do that automatically. And if the stock goes up 33%, remember to buy more. Again, here are the rules. And so, until next month, invest safely.